Hello Dragons, and welcome to this instructional video for Lesson 8 Part 1, the Federal Reserve System. The main idea behind this economics lesson is the Federal Reserve System acts as the central bank of the United States. With that in mind, by the end of watching this video, you'll be able to describe how the Panic of 1907 affected U.S. banking, explain the purposes and characteristics of the Federal Reserve System, and show the organization of the Fed. Now that the outcomes for this lesson have been shared with you, let's get started. When first proposed in 1790, the idea of a central bank was controversial, and it remained so throughout much of U.S. history. Although the first and second banks of the United States worked to strengthen and stabilize the national economy, many people felt that a central bank placed far too much economic power in the hands of the federal government. After the demise of the Second Bank of the United States, the government was not able to charter another central bank during the 1800s. Even a series of recessions during the late 1800s failed to revive public support for a central bank. The Panic of 1907, however, which caused the collapse of many banks and endangered the entire monetary system, broke the historic resistance to central banking. The Panic of 1907 had two causes. First, the nation's monetary system at the time had no mechanism for expanding the amount of money in circulation. This meant that business expansion was restricted because consumers and businesses competed for a fixed supply of loanable funds. As individuals and businesses found themselves unable to borrow money, they began to withdraw their savings. During these runs on banks, many depositors withdrew funds from an institution at the same time. As a result, financially stable banks went bankrupt in 1907 because they had nowhere to turn for emergency cash, and a widespread financial panic took hold. Second, the system of pyramided reserves failed. In a system of pyramided reserves, virtually all smaller local banks deposit some of their reserves at larger city banks. These larger city banks, in turn, deposit some of their own cash reserves in the largest commercial banks in a nation's financial centers, such as New York, Chicago, and San Francisco in the United States. These largest banks use part of these deposits to extend loans and hold the rest as reserves. During periods of prosperity, the larger commercial banks receive more deposits and have more funds to loan. At such times, a system of pyramided reserves encourages business expansion. During recessions, however, financial panic runs require smaller banks to withdraw their deposits from the larger banks. As happened in the Panic of 1907, the reserves of the larger banks could not cover the sudden demand for cash because they had loaned out too much of the deposits. Thus, many businesses went bankrupt, and many depositors lost their savings. To keep these two situations from recurring and causing another panic, in 1908 the newly created National Monetary Commission proposed the reestablishment of a central bank. Congress recognized the need and responded to the recommendation by passing the Federal Reserve Act in 1913. The act created a central bank called the Federal Reserve System, more commonly referred to as the Fed. The Fed's stated goals were, quote, to furnish an elastic currency and to establish a more effective supervision of banking in the United States. Today, the Fed achieves these goals by serving three main purposes. First, the Fed supervises member banks. Second, it holds cash reserves. These cash reserves represent funds available for short-term borrowing by commercial banks or by the government. The cash reserves guarantee that money is available in the economy when needed. Third, the Fed moves money into or out of circulation. In so doing, it is able to stabilize the national monetary and banking systems. The Fed is not the only central bank in the world. Many nations around the world, such as the United Kingdom, Japan, and Canada, have central banking systems. The U.S. Federal Reserve System, however, has several features that distinguish it from central banks in other nations. These features include lack of a single central bank, ownership and control by the member banks, and optional membership in the Fed for some banks. First, in most countries there is a single central bank. The Federal Reserve System, on the other hand, relies on district banks to carry out the banking policies developed at the national level. These district Federal Reserve banks, however, do have some flexibility in designing policies to best meet the unique needs of their districts. Second, in most countries with a central bank, the government owns all or most of the central bank's stock, allowing tight government control of a central bank. In contrast, the U.S. government does not own stock in the Fed. Instead, member banks own stock in the Federal Reserve banks in their respective districts. In part because this stock is held by member banks rather than by the government, the Fed operates with a high degree of independence from political authorities, although it does ultimately report to Congress. Third, most nations with a central banking system require all banks within their borders to be members of the central bank. In the United States, all nationally chartered banks are required to join the Fed. For state-chartered banks, however, membership in the Fed is optional. In fact, less than 40% of the commercial banks in the United States are members of the Federal Reserve System. The fact that the Federal Reserve System was designed to oversee banking practices throughout the United States caused many people to be concerned that a single central bank would hold too much power over the nation's economy. To avoid this problem and distribute financial control among different regions, the Fed is organized on two levels, national and district. The Fed makes its key decisions at the national level. The main decision-making bodies are the Board of Governors and the Federal Open Market Committee, or FOMC. The Board of Governors is the highest policy-making body in the Federal Reserve System. The board supervises the Fed's banking services and issues policies designed to regulate the supply of money in the economy. The President of the United States appoints, and then the Senate confirms, each of the 7 members of the Board of Governors. Each governor is appointed to a 14-year term. These terms are staggered so that one new governor is added to the board every 2 years. The board's chairperson serves a 4-year term. Long terms of office and staggered appointments are designed to free the governors from any political influence by the executive and legislative branches of the federal government, as well as to limit the influence of any one governor. The 7 members of the Board of Governors and the President of the Federal Reserve Bank of New York are permanent members of the FOMC. The remaining 4 members are District Federal Reserve Bank presidents who serve 1-year terms on a rotating basis. The traditional fear of a single bank dominated by a few financiers led to the decision to create 12 separate Federal Reserve banks. Each of these district banks serves a designated geographic region of the United States. In addition, 25 branch offices are located throughout the nation. All commercial banks chartered by the federal government are member banks of the Fed. The member banks in each Federal Reserve District elect 6 of the 9 directors of their Federal Reserve Bank. No more than 3 of the 6 directors may be bankers. Other directors often have experience as business owners. The Board of Governors selects the remaining 3 directors of each bank. So that's the way it is with Lesson 8, Part 1, the Federal Reserve System. At this point, you should know that the Fed provides commercial banks and the government a reliable source of cash, holds ready cash reserves to be used for short-term borrowing, and makes large loans to stabilize the monetary and banking systems. The Fed has several features that distinguish it from central banks in other countries, and the Fed is organized on district and national levels, coordinated by a central authority called the Board of Governors. Don't forget to subscribe to my channel to have the entire catalog of economics videos available at your fingertips. click the subscribe button, and then click the follow bell to receive notifications as to when the channel is updated. Thanks for watching, and I'll catch you in class, Dragons. See ya!